All right, good morning, everyone. It is 7:29 on the morning of January 31st, 2023, and this is my pre-market strategy session. And so today here in the pre-market, we've got a little bit more down motion happening. I'm looking at the Qs here, and they are down 0.45% from yesterday's close right now. And so far, this really looks like a fairly normal move in a pattern that is kind of setting up here. So we've got this Fibonacci level down here on the Qs, and this Fibonacci goes from, let me look again here, goes from, oh yeah, September of '02. Wow, look at that. The bottom of September of '02 all the way to the top of November 2021. And the 38.2 level was 260.41. And here in recent months, let's see, 1, 2, 3, 4 months, there were 3 tags of that Fibonacci level, and they closed up each time. So the 3 strikes you're out rule that I like a lot kind of applied here. Let's look at the daily chart again. And so we got these 3 tests of that 38.2 Fibonacci level, and the market found support each time. And so when something fails to go down, when the stock or the market fails to break down below, it's like, okay, well, the sellers are exhausted. Now it's time, for the buyers to dominate. And so what we've seen here since roughly the beginning of June here, June 6th, is let's show you here. Do some percentages right here. From the bottom to the top right here is about 9%, and then hang on a second, there's some background noise here. Hang on just a second for me. Okay, sorry about that. Okay, so there's about a 9% move happening from the fib to the top of this move that ended, let's say that's on the 18th of January. And so then again, we got another move from the bottom of the 19th of January to the top of, was that a couple days ago, it was Friday? Yeah, to the 27th of January. Almost a 9% move, right? And then also from the top of the down move to the bottom of the down move, we've got 3.79%. And then here from the top of this move to wherever we end up today, I'll just go roughly 4%, roughly. That puts us at a 287 level, roughly. And then so also tomorrow, we've got the FOMC. Well, the FOMC starts today, and then Jerome Powell will come out and say what he has to say, give his briefing, and then take questions from the press, journalists, so forth. And so far, the easing cycle, it's starting to happen. Jerome Powell, the Fed is starting to ease rates. Or I'm sorry, I should say they're still hawkish. They're not as hawkish. I think that they're going to raise 50 basis points tomorrow, which is pretty much what everybody expects. I mean, it's pretty much baked in already. And so then after this little pullback that happens yesterday and today, we'll probably see a third day of selling tomorrow up until the meeting, the FOMC briefing that Jay Powell gives, the end of the meetings and into the briefing, and then we'll probably turn it around. That's the way it looks to me. That's the way things are looking to me. You know, Powell's not going to say anything that's going to cause the market to crash. You know, it's just not going to happen. And we are in a central planning environment. For as much as we in America love to think that our economy is independent of any central authority, it's unfortunately not. The Federal Reserve has an outsized influence on the direction of markets, and that's the way it is. So even though the Fed is still tightening, it's tightening at a slower rate, and they only have a little bit further to go until until we get to what Jerome Powell thinks is probably going to be where inflation starts to come down to where his Federal Reserve rate is sitting. So that's going to be roughly somewhere around 500 basis points or 5% for a Fed funds rate, and we're close to that. So inflation, there's supposed to be another round of inflation coming at us because of this crazy omnibus bill that was passed by Congress, and as that spending kind of works its way through the economy, then these higher prices will be supported for longer. But that's too far into the weeds for me to think about. I'm just a trader, and less hawkish. A Fed that's less hawkish, even though it's still hawkish, a Fed that's less hawkish is still a little bit more bullish. That's the way it goes. I am expecting here. Certainly today, it looks like we're going to have another pullback today, and then possibly again tomorrow before Jerome Powell makes his statements and then answers questions. But then after that, I imagine it's probably, we're on our way back up again. And that's probably just about the way it's going to go. Let's take a look at the 10-year, 2-year. 10-year, 2 years doing the best it can to hang around this prior 699 basis point record. Put back in, let's see, I think that was in 2008. Let's see. Oh, no, that's 2000. So prior to this recent record low over here at negative 899 basis points, 699 basis points inversion was the record on the 10-2 as far back as this chart goes. And so now here we are, rates are doing the best they can to, kind of hang out around and above that 699 level. In my opinion, I think it's probably going to go deeper. I mean, the longer this whole recession or whatever it is coming at us goes, the deeper, in my opinion, the deeper the inversion will go. And things can be bullish all the way down here with this crazy inversion right here. It's not until we see the rates normalize again that we see the big crashes on the market, like we did right here and here in 2000, 2008, or 2001 and 2008. So I'm still bullish, although I think we are in the very, very short term going to see a little bit of a downturn in this. Hang on, let me get to it. In this bear market rally, right here. I think that we are about to see a couple days, 2-3 days red, and then we're going to take off back to the upside again. And then we'll see what happens from there. The next really big level is going to be 75%. In my opinion, that's roughly 312. A little bit. Let's see. Actually, we'll call it 311 and change. And then after that, the next big level will be over here. Let me get to why didn't that work? There we go. Yeah, this roughly 332 area will be the next big area to conquer. If we go above that, it'll be interesting to see. It'll be interesting to see. And again, I think this is all setting up extreme short term, meaning next 24, 48 hours. I'm bearish. Then after Wednesday, I'm bullish essentially, and I'm bullish until certainly this 311 area. And a breakthrough of that, I'd be bullish again until the 330 level. I don't expect any of this to happen in a straight line. I imagine it's probably going to happen, something like, squig. Nothing moves up in a straight line. Let's see, the VIX. So the VIX is back above 20, and this area around 912 is going to be support for the VIX. And you're not supposed to chart the VIX. It's not actually anything. There are products that are based on the VIX that are traded, but the VIX itself isn't traded. It's not like the S&P that actually has shares that are traded. This is just the VIX. It's purely conceptual, and there's no underlying asset. There's no anything underneath of it. It's just a measurement. So, the VIX, I think, is going to spend a couple of days, 2 or 3 days here above 19. Then after Wednesday, we ought to see it breaking back down below 19 again, kind of hanging around this 19 area, but below it. And yeah, that's pretty much what's going on. Let me go over to Bitcoin. Bitcoin's doing a pretty good job of hanging out up high. I think that this is short-lived again. I think that it's just a matter of time until Bitcoin comes back down again. This 19 area. We don't have much time. Mid-February, roughly, is when this neckline crosses below this previous high over here at 13,000. We'll see what happens there. That's pretty much what I've got going on for the day. All right, everybody, good luck out there. Keep your risk tight. Click like, share, subscribe, leave a comment, tap the bell. I'll see you at tomorrow morning's strategy session. Thanks for tuning in. I am out.